All right, let's go ahead and begin. Um, Thank you for joining us today. We are, right now, it is June 22nd, 2022, right after noon here in New York. Um, let's get down to business and let's see what's going on with the markets. We're seeing the markets give back some of its earlier gains. Um, for the last 11 weeks, we've had 10 weeks of negative performance in equities. We started yesterday, or we started the week off, with some positive performance, about 2.5% up in the broad market. And, in pre-market, we were down, but now it looks like we're flat, in the broad market, about zero point 0.3 or 0.4% up in the NASDAQ. All right. So, in last week, we had that huge, we had all these huge central bank meetings. Four of them were planned. One was an emergency one. It was the Fed here in the United States, the Bank of England, Swiss National Bank, and the Bank of Japan. And then we also had the emergency meeting called by the ECB. All of this has generated a lot of volatility within the bond market. And I think that's where we want to start today, as I think the bond market is very telling of where the markets may go going forward. All right. So this is an index that we've always been looking at on your screen here on my trading view. It's the MOVE index. It's basically the VIX of bonds. All right. And as you can see, it really, it really spiked up right before the big Fed meeting. And the Fed meeting was on the 15th. We saw the inflation numbers come out on the Friday before that. And then on that Monday, boom, we see volatility being priced in the bond market. And so that is still continuing up. We are not seeing that coming down. Okay. So there's a lot of volatility that's in the bond market. We'll see which way rates will go because of that. If we look at TNX, it is falling from around 3.5 or so. And I said that, the TIP TLT ratio, and again, that's the inflation protected treasury ETF divided by the long-term treasury ETF, and that just gives you a ratio of what the market is expecting going forward for inflation. If this graph is going up, the TIP over TLT, if it's going up, it means we have higher inflation expectations going forward. If it's coming down, it means that inflation has either peaked, or we're looking at slowing inflation, or possibly even deflation. Okay, so it's still in its range. It did pop up yesterday. It's coming back down. We will see right now if these levels hold and we either go sideways or we go down. It pretty much means that we're for this season, at least for this season, I defined it as around 3 to 6 months. For the next 3 to 6 months, that means that that inflation has peaked, and also that you can expect the Fed funds rate to be around 3.5 to 4%. Okay, so that is what this graph is saying. All right. Over the weekend too, we actually saw some signals that the Fed, finally, leaked out some rhetoric that maybe all that tightening that they had scheduled for, maybe it's not necessary to do all of that tightening. I can definitely see that. We're already seeing signs of inflation peaking. We're already seeing energy prices coming down. Gasoline prices are coming down in response to a gas tax. But I think the gas tax was just an excuse for something that was already going to happen with gasoline. It looked like from the last report, the EIA report, that gasoline usage had peaked for at least for the driving season. I mean, is it still possible that gasoline is still used at a high rate seasonally? Yes, of course. But I think that the market is already pricing in that peak in gasoline consumption, and I think the economics of it. If once we've been saying this for weeks. If gasoline comes down, that crack spread narrows between oil and gasoline, and therefore, the oil demand will go down once we see gasoline break. And so that we've been expecting this for a couple of weeks now, and we're getting that. Also, too, there's some interesting developments in the grain markets. I will be going over that soon. Actually, let's go over that right now. The inflation expectation is going down, and I think a lot of that has to do with what we're seeing in some of the energy markets. As I said, crude. That's the 1:15 minute. I want to look at the daily here. Okay, so as you can see here, crude is breaking down. It's off its lows today. It's trying to regain some ground, but it's still off by about 3%. We have gasoline. Again, the gasoline seems to front run oil, so gasoline is also down, also trying to recover some of its losses of the day. I told people a couple of weeks ago that I'll be looking for those grain numbers, especially corn, okay? And see, if the amount of corn planted was low, if the numbers had come out really low, I said that you can expect the 10-year to spike, the 10-year yield to spike because of more inflation fears. So as there's more inflation fears, then there's more fears of an aggressive Fed. Okay, and so we're not getting that. All right, some information came out, and it looks like farmers were able to plant their corn in time. Okay, so the reason why a lot of farmers were putting off on planting corn was because of weather. And second, because of the cost of fertilizers. The cost of fertilizer has actually come down. Natural gas prices have come down. Fertilizer prices have come down. All right. And so the reason why I said this about a couple of weeks ago, that there's a chance that all these planters may decide to go towards soy. It's because corn is very nutrient intensive. All right, you need a lot of fertilizer. Every 1 to 2 crop cycles, you have to fertilize the soil because it just leaches all the nutrients out of the soil. Soy is regenerative, so if you plant, that's why people rotate between corn and soy. You do 1 or 2 corn plants, and then you'll do, most farmers will then do a soy to put nutrients back into the soil, and so. Again, because of fertilizer prices being where they were, and plus the weather, a lot of farmers held off on planting corn. Well, it looks like they've gone ahead and planted that. So it looks like the corn yields may be revised higher. Okay, so I'm actually going to look for shorts in corn. If corn rebounds just a little bit more, I may start a put spread on corn. We will see. The thing about corn, though, is that the right now the put skew is not very favorable to a put vertical spread, but we shall see. I mean, maybe it changes if it goes up just a little bit, but if we go to corn on the options chain, I'm looking at either September's or December. I think December's a little bit too far out. I'm looking at September's. I mean, it really just depends. 690 to 640 seems all right. 690, 640 would be around 20. Right? Yeah, it'd be about 20 to make 50. So it would cost, you would be buying this, and you would be buying the 690, selling this 640, and the total premium that you would pay is about 20 per spread, and you have the chance of making 50. That seems like an all right spread. I would like to get it a little bit cheaper if possible. If possible, I'd like to, maybe even go down the chain a little bit. But I'm not even going to scale in at this level. I would like to see a little bit higher, it rebound a little bit more before I start. And that will also be a tight stop if for some reason corn keeps going up, because also too it's also weather related, and we're in the Midwest. They are having higher than expected temperatures. So if the corn that they planted doesn't make it because of heat, then again corn prices could spike. So outside of something crazy going on with the weather, I do expect corn prices to come down. I do expect I do expect there to be some revisions on expected corn supply during harvest. All right. Again, fertilizer costs are going down too, so yields should be higher. Again, it's all weather dependent, and the risk is right now that heat in the Midwest. But we'll see. Minus anything too terrible weather-wise, I think this should come down, and that's what's supporting my new outlook and rates. I think maybe this is the seasonal high. I think it is a seasonal high in long-term Treasury yields, perhaps at 3.5 area. Could it go higher? Of course, and already the Fed over the weekend, as I said, has signaled that they might not need to be as hawkish to fight this inflation, but we'll see. I am not too sure about that outlook. I think that, I think, just like in the 70s, that's what happened. They would raise interest rates a little bit, and then inflation would go away or peak a little bit, and then they would be scared of a recession, or they'd be scared of stifling growth too much. So then they would start easing again, and then maybe a year or two down the road, inflation would come back and roar back. And this is, this happens, and that lasted for 7 or 8 years. I don't think this round is going to last that long. Markets are way faster than before. Money travels between borders at a much faster speed than ever before. So I don't see the lost decade, as I've been saying for a few months now. I don't see it as a full decade. I think it's going to be like 5 or 6 years, but we could see a mini bull market happening, probably maybe end of this year into next year. And then most likely commodity prices will come back. I think so. My thesis is that, this is just a temporary high for bond yields. I still think bond yields are going to get higher. I think inflation will still come back, even if it peaks here for the next 3 to 6 months. Maybe next year I see it coming back. And then they'll have to go through a whole new rate, a whole new tightening schedule again. And that's when it's going to be bad, especially I think in 2024. I think not only is there going to have to be a monetary policy change, with tightening and higher interest rates, but there may have to even be a fiscal change. Perhaps more taxes will have to get levied, and budget deficits will have to be addressed. And I think that will happen more toward 2024 if inflation comes back. And that will be the bad one. That will be a really bad year. But until then, we'll take things one session at a time. I'm not trying to predict the future. I'm just anticipating 5 or 6 moves ahead just in case if we get there. But that's just what I see so far. Okay. Also, here is our yield spread between 10 and 2 for the treasuries. If this goes up, that's supportive of bank stocks. If this goes down, then that would be not very good for bank stocks. It would probably bring the Dow down and probably also bring the markets down. And it would be a huge recessionary signal. Okay. Does yield curve inversion always mean recession? No, it does give out. It does do. It gives out some false signals sometimes, but we'll see. Whenever this comes down, though, bank stocks tend not to do well. If this goes up, bank stocks do better. Okay. and that's just the 10-year yield minus the 2-year yield. All right. Let's go through general market. So in a nutshell, again, it looks like energy costs are coming down. It looks like we're seeing peak commodities for this season. I do expect that maybe 3 to 6 months down the road, it may come back. But for now, it looks like commodities have peaked, especially, I think, for corn and for oil. All right. Let's just take a look at oil one more time. Let's just go back to the charts. That's corn. Again, I just want a little bit higher, and then I start. I'll buy a put vertical spread. For oil, same thing. I'm not sure if we're gonna get a bounce in oil, but if we do, I would love to. I would love to see oil come back to like 120. If it does, oh my goodness, what an opportunity that would be. Okay. Am I gonna long oil here? No, because what if it falls further? There's no edge. If it falls further, then I'm gonna have to watch it fall down. And where am I gonna place my stop? There's no effective way of managing risk. The best risk to reward trade in oil is to wait for this to come back up and then short here. Okay. For those of you who don't have futures, you can use XLE. All right. If XLE comes back to around this 86, 87. Definitely a good place to buy some put vertical debit spreads, okay, or short. All right. We talked about XLE peaking on this day right here, pre-market. We talked about it here at Checkmate Trading Discord. Shouldn't have waited. In hindsight, should have been more aggressive. I think in this market, you can be a little bit aggressive in shorting. But at the time, I thought, hey, if it rebounds, I don't want to be holding a bag. And I wanted to do it here, but it never gave us that opportunity. It just went straight down. So we should have made some moves right there when we had noticed. That right there is when we saw gasoline peaking. So that's when I said, hey, it looks like oil stocks may be peaking. So should have been more aggressive there. But it is what it is. Let's take a look at some of our trades. As always, I like to show you my positions and where I'm at. This is the oldest position that we have is UVXY. I'm still in UVXY call spreads. The 15-20 for December. That's long 15 call strikes and a short the 20. I do have an open order to close the position. As I've told you in last week, I put it for a few ticks under full profit. Full profit would be 5 per spread. I think I put the order at like 475. So if and also too, because these are a little bit longer dated, gamma is not working toward my favor as much. So if UVXY, if the VIX and volatility spikes in the overall equity markets, in order for me to get full profit on this, in the next month or so, UVXY would have to be in the 30s. If we get closer and closer to expiration, then it would be lower. All right. And that's just due to the gamma effect. Okay. By the way, let's look at the Australian dollar. It was breaking down. It had much bigger losses today. I said that, hey, wherever Australian dollar goes, China follows. Okay, it was breaking down. We saw a little bit of a relief rally in FXI and in Chinese stocks, and I said, you know what? I think the market. I think China's bluffing. The at least Chinese equity markets are bluffing because Australian dollar is not breaking out too. It kept getting rejected at these levels. So I said, you know what? I bet you it's a fake move, and guess what? Did I say FXI was going to follow AUD USD, or did I say it was going to follow AUD USD? And in fact, it did, and we are lower. Okay, so our position, it recouped some of its losses. I'm still holding on to the puts. I still think there's more downside to go. Another lie detector test for China is copper. Okay, copper coming down. It's just because China is one of the biggest importers of copper, and whenever the outlook doesn't look good for China, the price of copper goes down in response. All right, and they usually buy a lot of their metals and minerals from Australia. So whenever they're doing well, the demand for Australian dollar goes up because their commodities need to get bought in their currency. Okay, so our FXI position again is the I have some, not a lot. I just scaled in just a little bit of the 31 puts for FXI. Okay, we'll see if it pays out. I still got about 2 months on it. In hindsight, I should have done put vertical spreads, but I just bought naked puts. We'll see how it goes. The dollar also has been going up today, or actually coming down today, actually. It was up earlier in the pre-market, and then it lost some ground. If, this week, if the dollar closes below the lows that was made on the 16th, if it closes below there, I may exit the EEM puts that I have. It's not because I still think that there will be an emerging market credit crisis sometime in 2023. I still think that is going to be the case, but it may take a little bit longer. If the dollar comes down, that may take a little bit longer, and I don't want to be holding this March put at a loss. I would rather just cut the loss, cut it at a small loss, wait for another signal, and get back in later on. Okay, but we shall see. Okay, as long as the dollar stays above that level this week, I'm still going to keep my put. And again, just for you to have proof, March 23rd, March 2023, I have the 39 puts. We're at a slight price. It's almost break even, pretty much break even. Okay, so we shall see. I don't know what's going to happen to this. But I have it long dated just in case. All right. Gold. Last time, yesterday, I entered a gold position. Partially, it's because what if the dollar comes down? All right. Generally, when the dollar comes down, that is good. That's good for gold. Generally, people always say that gold is a hedge on inflation. It's actually a very, very poor hedge on inflation. If you look back at history, generally, I think the more accurate statement is gold is a hedge on currency risk, not inflation. Currency risk, wild movements, volatility in the currency markets. That's what gold is a hedge on. It's a hedge on the volatility of currency markets. Okay, we're already seeing some countries having their currencies fall too fast against the dollar. One of them being Hong Kong. Hong Kong is one of those weird markets. They don't actually have a central bank. They have a currency board. It's like one of the things that's left over from their old colonial days when they were a colony of Great Britain. They have a currency board. It's also one of the few modern economies where the government doesn't issue currency. It's 3 private banks. It's the Bank of China, HSBC, and Standard Chartered Bank that issue their currencies over there. Hong Kong generally does peg their currency to the dollar. It is starting to lose that peg. All right. At some point, they will have to also tighten. And when that happens, and this is not something that is just going to happen in Hong Kong. I think this is going to spread to most emerging market countries. Hong Kong is not an emerging market place by any means. It's a very advanced and wealthy economy, but places like Thailand, places like Southeast Asian countries, Latin American countries, Greece, some Southern European countries, Turkey. There, you're going to start seeing some problems when they start when they have to tighten. Companies that have high leverage will need to deleverage. They'll either need to get leaner or they'll go out of business. And I think that's going to happen in 2023, and that's why I still have my EEM puts. I that's a bet that it's going to happen sooner than later. Of course, I kept everything really small. Most of my account is still in cash. So, all of these positions that I'm talking about are extremely small right now. I really haven't legged in that much. I may add a little bit more to the China put spreads, and I may even go out to September, and the gold put spreads. I may add a little bit more, but anyway, I went on a tangent there. The gold is a hedge on currency risk, all right. And so if the dollar drops, all right, and there's a lot of volatility in other currencies, I can definitely see gold demand going up. Another country that I think where gold demand is going to be high is Japan. All right, Japan is the only out of the five or four central bank meetings, Japan is the lone dove. Okay, they're still printing money, they're still keeping interest rates really low, but already they're starting to see signs of increasing inflation, and already in their country they're seeing talks of potential tightening that they may have to do to curb inflation. All right. And so I can definitely see in if those who hold yen may have to hedge their currency risks. So one issue too is that since Japanese bond yields are so low, a lot of Japanese bond investors have been investing in overseas bonds. Well, if interest rates go up in Japan, now all those overseas bonds are going to have competition as far as Japanese investors are concerned. And so some Japanese investors may bring their money back to Japan, buying yen and buying their own bonds. Usually a strengthening yen is a risk off signal. All right. So that's something to look into. And also too, if they suck money out of other countries, that also further reduces liquidity. So there's that concern. That is a reason why I got those gold spreads, because if the dollar drops, I will probably take a loss on the EEM, but I think gold will go up. So we have a little bit of a negative correlation there, and I wanted to make sure not every position I have is all correlated to the same events. So that's why the gold long seemed pretty appealing. Also too, I think there's going to be a floor on gold prices as long as industrial demand goes down. One thing that I'm looking at is gold futures. Hold on, gold futures divided by copper futures. Okay, this is a well-known ratio. Basically, it's the commodities traders' risk on and risk off sentiment for global trade. When you see this going up, all right, generally that is a risk off sentiment. When it's coming down, it's a risk on sentiment. HG copper is an industrial metal. All right, I mean gold is an industrial metal too, but usually it's more of a safe store of value and a hedge against currency risk. So generally when you see gold outperforming copper, as you're starting to witness now, is generally a risk off sentiment. A risk on sentiment would be industrial metals outperforming the store of value, which we saw after COVID. Okay, well, all the stimuluses that came out, basically, more copper was getting bought, gold got sold, boom. Okay, I think we're going to see gold outperforming copper in the short term. Also, another graph that I have here is the I showed this yesterday. It's gold divided by S&P 500. All right, I do believe that this is going to go up a little bit. All right, but again, I'm scaling in slowly because metal movements tend to be a little bit more drawn out. So it's not like these linear moves. Usually, there's it chops around a little bit before making its major move. So we'll see. And again, I'm still long on those. Yesterday it looked like I timed it wrong, but today it's up. So I think it's around flat right now. And again, it was the 180, 200 call spread for December, monthly OpX, long the 180, short the 200. I bought it for, I believe it was like $3.55 per spread. $355 per spread contract. My my max payout from each spread would be $2,000. So the profit would be what, 1600 $1,600 and $1,655 is my max profit for $355 of risk. So it's about 5-to-1 reward to risk ratio. Okay. I may be adding to that slowly. Okay. If this comes down a little bit more, yes, I'm going to start, add some more positions to this. Okay. Those are the positions that I have open currently. And again, if anything changes, I will always, let you guys know via one of these calls, or if it's not a scheduled call time, I will definitely go over it and post it on our Discord chat group. Okay. Any questions? Actually, you guys, if you want, you can take yourselves off of mute. I am streaming right now, but I have the computer volume set to mute, so anything you guys say won't show up on the stream or on the recording. Or if you guys want to, you can just type it in voice chat text. Hey. Okay. Right. And so, I think if the dollar, it just depends on right now. It's dollars in kind of no man's land. Actually, let's just pull up the dollar. Oh, the dollar chart's right here. So yeah, you're exactly right. Right now it's just kind of consolidating right here. And the question was, do I still think that metals are going to go up because dollar is not coming down? It just really depends. I think if the market is expecting this to be peak inflation for this season, and if interest rates do start calming down, I can see dollar coming down. And again, if the dollar breaks this low right here, this 103, let's say 103.20 to 103.40. Yeah, I can see dollar coming down to around, the 100s or so, and probably stay there for 3 to 6 months. But at some point, I do expect inflation to come back, and the hawkish tone of the Fed to come back, just like in the 70s, and then we'll probably see the dollar go up again. This trade in metals, it's only till December. So if, let's say, I'm proven wrong, and let's say the dollar spikes and gold comes down, well, then in that case, I get out of my gold spread, and and then my EEM puts and my China puts will do extremely well then. Okay. So gold, basically, if we close under this level right here, if we close under 1800 or so, that means I'm wrong and I get out of that spread. Boom, easy. That's why I chose this level, because my risk is small. If it goes to 800, boom, I lose a little bit on my December spread. I move on, and we just, we look for profits in our short EEM, or our EEM long puts and our FXI long puts. Okay. So that's why I have EEM long puts, FXI long puts, and then I have cost spreads on gold. Depending on which way the dollar goes, one side or the other is going to profit more. So that's how I have it structured. And everything I have is extremely small position right now. I just legged in on everything. Like, I still think I'm 97% of my spec account is still cash. 97 or 98% of my spec account still cash. Okay. Uh huh. Okay. Right. I think this season, yeah. I mean, for especially in energy and in grains, like I said, the 2 weeks ago, I said that there was a possibility that corn could spike, sending new inflation fears in the market. That's not coming to fruition. Okay, it looks like planters did plant their corn. Fertilizer prices are coming down because natural gas prices are coming down. When fertilizer prices come down, that means they get used. Fertilizers are going to get more used. We're going to see higher yields in grains. I wouldn't trade wheats just because wheat is so tied to the Russia and Ukraine conflict. And corn is the one. In the United States, usually it's corn versus soy. It's 1 to 2 plants of corn, and that will leach out all the nutrients out of your soil. Then you plant soy. Soy is regenerative, puts nutrients back into the soil. So the problem was that one of the issues that we were facing was that if they do mostly soy, then corn prices go up, and corn is something that's used a lot in food for humans. Soy, a lot of soy gets used for animal feed. So as far as food is concerned, I think food inflation has peaked for this season. Again, that's 3 to 6 months. I still think that after 3 to 6 months, like toward maybe even up to a year, maybe end of 2023, even possibly 2024, we'll see inflation come back again. But everybody who's long on commodities is probably going to get wiped out before that happens. Yeah, exactly. They're probably going to get wiped out. Yeah. Yes. You mean not go short? Yeah. Yeah, does it have more room to go? I don't think so, because right now the expectation is that corn yields are going to be so low, but I think they're going to revise it higher because of all of this. I think corn yields are going to go higher. Fertilizers are cheap now. Okay, so at first farmers did not want to pay for that high cost of fertilizers, but now fertilizer costs are coming down. So they're going to use it. Yields are going to be higher. I think they're going to revise the numbers higher for corn supply in August and September. And, I think it'll be a decent harvest. Again, the only risk here is the weather. The Midwest weather has been kind of erratic. And temperatures have been soaring. I mean, I saw some of these temperatures like 100 plus temperatures. So we'll see. I mean, outside of a major weather disaster, I just don't see that happening. I think that corn prices will probably come down again for the season, maybe 3 to 6 months, maybe to a year. But I think inflation will come back just because, and also it's also Fed dependent too. If the Fed is going to learn from Volcker, then they're probably going to keep tightening in the face of inflation peaking. Okay, so even if they see inflation numbers coming down for the next 5 or 6 reports, if they keep tightening into that and do what Volcker did and just keep tightening to really get inflation out, then this could be a quick solve. But if they get pressured and say, hey, well, now inflation is slowing down, why are you restricting the economy so much? And if they start loosening too early, like they did in the 70s, then this is a problem that could last a while. That's why inflation is such a sticky problem. It usually lasts about 6-7 years or even up to 10 years. If you look back at history, this happened in the 1970s. This happened in the 1910s. Every 50 years or so, this happens. And inflation, again, it's just like, they raise it a little bit, they tighten a little bit. Oh, inflation is peaking. Oh, it's not as bad as before. Now we have to save ourselves from a recession, and then they loosen, and then a year or two later, inflation will come back, and it'll come back even worse. All right, and so yeah. I think too, you just mentioned that, it'll put us in a recession if the Fed is aggressive. I think a recession is going to happen regardless at this point. Yeah. Yeah, but when they say tank it all, okay, so, you mentioned like, oh, the only solution seems to be to tank it all. I mean, you have to be careful how you use the word tank it all. This is not a systemic problem. This is not like 2007, 2008 where there's all these bad loans on the books. Yes, there's going to be a recession. That means like unemployment will go up a little bit. We'll see GDP contraction, but it's not going to be like the same as 2007, 2008, or like a systemic problem, or anything along those lines. I do think that though, if this persists and inflation goes to 12, 13%, maybe in a few years, then yeah, we could probably see deeper contractions that are needed in the market. But as of now, it's hard to say because that's too far in the future, and then nobody can tell. No one can tell what the Fed is going to do. I don't know how, even if the Fed gets dovish, how dovish are they going to be? That's a really hard question to ask, and so we will take things as they come. We'll take things day by day. I'm not trying to predict the future. I'm just trying to anticipate what may be 5 or 6 moves down the road. Of course, we call ourselves checkmate trading, right? It's like playing chess. You don't know what your opponent is going to do exactly, but you can anticipate 5 or 6 moves ahead based on how the board is set up. And that's just what we're trying to do. We're just trying to anticipate for several moves ahead. But I do think that it is very possible that we see a mini bull market in this otherwise multi-year kind of flattening of asset prices, what economists call a lost decade. I think this lost decade may last about 5 to 7 years, where asset prices just chop around certain levels. If you go back in the 70s, that's what happened. The highs was like 68, 69. Boom, we had all these inflation fears, Hong Kong flu, all these military conflicts, OPEC, restricting oil, and we didn't really get out of it until 1980. So, that was a lost decade. I can see definitely us doing that. Now, the bottom happened, in 1970s, the bottom happened when inflation was at its worst, which it was around 74 when, oil prices spiked for the first time because of the Yom Kippur Wars. About a year after that, I think that was like around the bottom, 74, 75, something like that. Do I think this could be the bottom? I mean, it could be. And maybe we just chop around between 3,800 and 4,200 for the next 4 or 5 years. Very possible. Or maybe we rally up to 4,400. Everybody thinks the bear market is over, and then we tank in 2024. It could be that too. I'm just trying to open your eyes to the possibilities that it doesn't have to go all lower all at once. All right. It's probably not going to be a straight line. Exactly. And you know what? And a lot of people are going to get chopped out both ways. Bulls are going to get chopped out. Bears are going to get chopped out. I think what's really important is to look at those macro trends and really set yourself up 5 or 6 moves ahead. Again, that's why I'm looking at EEM. I'm looking at emerging market debt crisis. I'm looking at China coming down. I'm also looking at gold going up. I'm trying to anticipate things months in advance, and that's why that's why my put spreads are all like 3 to 6 months out. The China thing, I don't know. I got I got a little too greedy on the timing of that. I should have done September or November put debit spreads, but instead I went naked long on puts for August. That one is the only one I did a little bit shorter dated, but everything else is at least 3 to 6 months out. I think there's going to be a lot of chop. There's going to be a lot of noise in the price. But I think there's certain key things we need to look at. I think the currency and bond markets are going to be really telling. So again, it's the MOVE index, the volatility in bonds, TIP over TLT, the dollar. These are the things we really want to look at. And I think those are going to give us the clearer signals. VIX right now, it's all over the place. There is a demand for hedging. I do see that there are certain levels like 3,700 and 3,600. Those are huge levels. If we make a decisive move under 3,600 within the S&P 500, there's going to be huge demand for puts, out the money puts. Once we lose 3,600, there will be real fresh demand. So 3,600 is going to be a pivot. If we hit 3,600, we're either going to, and just keep this in mind, okay? And again, I can't tell the future. I'm just trying to anticipate what may be. If the S&P 500 hits 3,600 and at the same time we're trending down on implied volatility, meaning we're trending down on the VIX, I think 3,600 could be a point where we rally, okay? If we hit 3,600, but the VIX keeps going up, and we lose 3,600, goodbye. We're seeing 34, okay? We're going to see 3,400 then, all right? So that's going to be the tell, 3,600. So we're not there yet. That's where I see a lot of volume. I saw a lot of volume last week on the 3,600 strike, not only for the next monthly OpX and S&P 500 cash like SPX, not just in the next month, but also in the months afterwards. So there's a lot of hedging demand for 3,600. If we lose that, I think we see fresh hedging demand coming into the picture. So that's my equity outlook, at least. Right. Yeah. Well, okay. So if you look at SPY, I know you just joined. Yeah. 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 So no. So here is the chart. Here I put the levels on here, and these levels actually go back a long ways back. These levels are not some TA lines. These are valuation lines based on different interest rate expectations. So when if interest rates fall at different levels, then the multiples are going to be different. Okay, so I shared this about a week ago. You can look past at some of our previous videos, but I'll just go over it very briefly. But if interest rates are around like 3 to 3.5, that's the value zone right here, where institutions will find value in buying S&P 500. It'll be 361. At 3.5 to 4 in treasuries, we're looking at 342. Okay, and if interest rates go even further than that, let's say 4 to 4.5, we're looking at more like 320. And then if we go past into the fives, we're looking at 295, 296. Okay, so those are some of the valuation lines in SPY. So even in our local like 3 to 6 month outlook, if 3.5 to 4 is really what we're looking at as the top of the range in Fed funds rates, then I think we can expect 342 to be a very good value zone for institutions to come in and buy the S&P 500 based on forward expectations on earnings and based on a pretty low earnings multiple, actually. And so I think that's a very good zone right here to start legging into SPY shares for multi-year buying. I'm not talking about call buying. I'm talking about buying shares for your long-term portfolio for 5-10 years plus holding periods. I think starting to scale in at 343, 342 is probably a very good idea in my opinion. Okay. The triple Qs. The question was, what do I think about triple Qs? Tech is the most one of the most interest rate sensitive indexes. If interest rates go up, if inflation comes back, QQQ is going to get hit down the hardest. If liquidity really rushes into the market, QQQ is going to do very, very well. There's going to be certain parts of the NASDAQ that do better than others. I think that NASDAQ stocks that are focused more on current earnings are going to do better. So I'm looking at Apple and Microsoft. NASDAQ, maybe in a couple of years, NASDAQ may not even look like a tech index. And that's what actually happened after the 1999-2000 tech bubble crash. The NASDAQ briefly became a non-tech index. Companies like Costco and all these other companies, healthcare companies, took a bigger share of the NASDAQ index than tech stocks did. And I can see that happening. I can see Costco's and some of the healthcare stocks and some of the other service-oriented stocks taking over the NASDAQ maybe in a couple of years if tech stocks keep getting pummeled because of higher interest rates. Yeah. Yeah, man. Stick around, dude. Hey, not only am I on Discord right now, again, as I said, we're expanding, dude. We're streaming right now live on YouTube. We're live on Twitch right now. I'm gonna keep those two venues open. So I know some of you guys stream from your phones at work, and I know sometimes Discord can kind of be uncomfortable in streaming. So yeah, I know Twitch is very simple, is streaming from your phone, and also the view is a lot better. You can make it your full screen on your phone. So stream us on Twitch, stream me on YouTube. All the videos that I do will automatically get recorded onto YouTube. So if you miss a day, you can always go back to our YouTube channel and watch the high noon highlights. Those are our scheduled calls, is the high noon highlights at noon Eastern time. But regularly, in the mornings and at the close of business, I usually get back on this voice chat. Twitch is just very, very good for just streaming, like for long periods of time. Even if I'm not on, I'll leave my computer on so you can look at the charts that I'm looking at and that I'm focusing on, the important charts and the important data that's streaming. I'll just keep that on Twitch for most of the day. So even if I'm not on, you can at least see what I'm looking at and what I'm focusing on throughout the day. Hey, not a problem at all, man. Thanks for coming by. I was getting worried about you, man. I didn't even hear from you, so... Oh, okay. Yeah. Right. Yeah. And the thing is, just a little caveat to that, starting buying at 340. If we rally first before getting there, and let's say we rally to like around the 400s, like 390s to 400s, I will build put walls in my portfolio like 3 to 6 months out. So my plan is, if this thing rallies, like let's say like, oh, like tomorrow for some reason, like everybody just sells off their puts, market maker has to buy these puts and then buy the underlying to stay delta neutral. Let's say that happens. Again, I'm not trying to predict the future, just anticipating just in case. But if the market rallies hard and it goes to like 390, 400 zone, I will buy some put spreads, so put vertical spreads 3 to 6 months out, with like a 4-to-1 reward to risk ratio. Okay, so if they're $5 wide, I'll be trying to get them for $1.25 or less. All right, so yeah, right, yeah. And actually, and no, the strategy that I'm telling you about to building those put walls 3 to 6 months out, I purposely share those strategies with you guys because those are the strategies for non-active traders. If you notice, I have not mentioned, on these videos at least, I do post lottos on the Discord every once in a while. Those lottos like zero DTEs and things like that. But you guys, especially on the stream or especially on the high noon highlights, most of the trades I go over are long dated. I mean, the UVXY call spreads that I bought like a month ago, they're all the way out to December. My EEM puts are all the way out to March 2023. My gold call spreads are out to December. Okay, I purposely do that because I know most of you guys work, and me too. This is my busy season in my other business, so I can't always be in front of my terminal at all times. And so I agree with you. And in this market, you don't want to be short time wise. Yeah, yeah. You want to be able to withstand some chop for a few weeks. All right. And so I agree with you 100%. And most of my trading that I post on these videos are going to be for people that may not want to be in front of their computer for whatever reason all day. Okay. This is for like more like swing trader, like multi-week moves. Okay, that right, really in this market, that's where all the money is. The money is not in these like 1 to 2 day moves. It's in these moves that take weeks to form. That's where the big money is. Like for example, in April, I posted all those put spreads that I bought for September. I mean, those doubled and tripled by May. Okay, those are the big moves. So let's go back here. Let's go back to the chart here. So look at my SPY chart. If you look back in my, well, you weren't here in the Discord then, but you can go actually on my Twitter and you can see on, March, April, where I started building triple Q put spreads. Right around here, I started buying puts 3 to 6 months out. Okay, I held it all the way down to here. So this move gave me double, triple of that. Okay. And those are the moves you really want to lean on. And that one, I was not in front of my terminal for it. I just put a take profit level and boom, within 3 weeks, we hit it. I double, tripled that. I put about 50% of my spec portfolio because, I use my spec portfolio to hedge against my long-term SPY shares. And so, that was a huge move. And then right now I'm just waiting for another rally so that I can do that again. Oh yeah. 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 a little further out and using spreads, because when you use a spread, when you short a more out the money option, at least and not only that, you mitigate some of that IV crush and some of that theta. Okay, and so that's another thing. Because you said it yourself. Volatility is so high that the premiums are high. Well, you kind of want to counteract that IV loss with a short strike, and that's why those vertical debits are going to be wonderful in this market environment. That's why I've been always preaching about vertical debit spreads. If you actually look at, also, you go back on YouTube, several of those videos, I go over a tutorial, like quick tutorials on how to build those vertical debit spreads that are 3 to 6 months out. I highly recommend you go through that. And you do that. And also too, you can go on Google right now and you can go through building vertical debits. And actually, if there's enough demand for this, maybe tomorrow on the high noon highlights, I'll go over that again on how to build those vertical debit spreads. But I think in this market, with IV being that high, those vertical debits are really going to help you manage that risk. And in the end, I always keep saying this, our number one job as traders is to manage risk and protect capital. Those two things are first, second, and third, okay? Profits come when you do those two things. You have to manage your risk and protect your capital. If you do those two things and you always think about those two things, profits will come, okay? So it's all about risk management. Yeah. Oh no. Oh no. The liquidity is not, those days are not over, and I'll tell you why fundamentally, and not to get too complicated into macroeconomics, because I know some of you guys, don't understand it, but just so that you guys understand what you're seeing in the media and stuff. Since 2008, we've had really, really cheap credit. Money was basically free. The cost of money was free. When liquidity is that high, when interest rates are that low, okay, there is no other alternative. Cash is no yield or negative, all right? Bonds, what were bonds paying? Bonds were like close to zero. I remember 10-year treasury was at 0.6%. There was no other alternative but to buy stocks. Now, there's so many alternatives. Dollar, let's look at the dollar chart again. The dollar is on an uptrend, right? Dollar rampage. They call it King Dollar on CNBC. The dollar is an alternative. Cash is an alternative. Not only that, short-term bonds. Right now, a 2-year treasury bond pays 3.3, 3.25. Okay, there is alternatives now. There is competition for money. Stock market doesn't have is not the monopoly doesn't have the monopoly on good ideas anymore. Financial advisors and all these wealth managers always said, buy stocks. There's no other alternative. Well, now there is. With interest rates going up and everything, there's more competition. So I agree 100%. Even if we do recover and do have a relief rally, it's going to be a choppy rally because, again, there's going to be profit taking. People are going to make decisions. Hey, is it worth it to have that equity risk, or should I convert these profits into bonds? And that second part now is an alternative. That alternative was not there 7-8 months ago. Now there is. Okay. And people think this is unusual. No, the last 10 years have been unusual. If you look at the last 100 years, what we're going through now is actually more normal. We're actually going more to more normal markets. Price discovery actually used to be a thing. It used to not be just like, oh, buy every dip. If it dips 1%, you buy. That's a very new phenomena. That wasn't the case before QE era in 2008. So I would say this is more normal markets where liquidity has competition. Okay, there is competition for money. All right, that's the way it quote unquote should be. Okay, so don't let the media tell you that this is an unusual time. No, it's not. This is normal. Yeah, and it's unusual for young people. the thumbnail for the YouTube video that I have that's going to be posted today is going to have a meme where it says Gen Z like, oh my God, there's a recession coming, and then millennials are like, oh, so it's your first one. Like, it's just, anybody who's been trading for like multi decades knows that we're going more toward normal times. Now, having said that, most people did not trade back in the 70s. I know most of you guys here on Twitch or YouTube or on Discord, you guys are younger. You probably haven't seen something like this. Maybe you saw 2008, 2009, but this is definitely something that most people haven't seen. Be ready, okay? Be ready. I've been saying this for months, dude. We might have a lost decade. That lost decade may not be a full 10 years. It may be 5 or 7 years, but we may have little bull markets in between the secular bear market. Okay, bull market rallies. The last bull market rally back in end of May till like, let's say 2 weeks ago, that was like 2 or 3 weeks long. But if you look back in the 70s, there were bear market rallies that lasted for a year and a half. Okay, and so people think it's over by then, but no, it just means the market is taking its time to digest more economic data to go back to its bigger downtrend. Okay, I've said it before and I'll say it again. Most bears get wiped out in a bear market. Why do bears get wiped out in a bear market? Because they keep shorting into bear market rallies, and bear market rallies can be vicious. Okay, and I just speak from personal experience too. Back in 2008, I almost went homeless because I shorted into a bear market rally. Okay, literally the S&P 500 did 10% in one day, and I thought that was impossible to do in a bear market. Oh no, 5 days later, we started the downtrend again, and we went down another 20% after that. But I lost so much capital trying to short that bear market rally that I didn't have enough funds to short when the real move happened. And that's where bears get wiped out in bear markets. Okay, you have to go with what the data says. It's not about the story. Okay, the market will tell you where you need to go. Okay, the story is what causes us to lose our money. Opinions don't matter, and Jesse Livermore said this. Opinions are often wrong, but the market is never wrong. Okay, if there is a disagreement between two opinions, the final arbiter of that argument is always the market. Okay, do as he says, not as he does. He was a great writer on risk management. Unfortunately, he didn't take his own advice. Every time he made money, he lost it. And the last time he lost money, he was in his 60s. He took his own life afterwards. So don't do as he does. Do as he says. Okay, manage that risk. Okay, and do what the market tells you. Follow the market. Don't try to fight against the market. Okay. All right. Very good. Oh yeah, man. Great. I'm glad to have you, LT. I messaged you like when we first started this, like about a month ago. No, not a month. It hasn't been that long. Maybe 2 or 3 weeks ago. I always wanted you to join, so I'm glad that you found your way here. Oh, MSC, yeah, dude. MSC is a great contributor too. He always puts stuff about crypto, and he's always letting us know what's going on in the crypto markets. So, yeah, man, he'll tell you, and yeah. Oh, oh yeah. Yeah. Yeah, but again, again, I don't tell yourselves these stories You never know, okay? What if China reopens and all of a sudden everything becomes cheaper because the supply chain issue gets solved? What if, I don't know, what if Vladimir Putin doesn't wake up one day? You know, what if he doesn't wake up one day and all of a sudden this war is over and now there's a flood of grain in the markets and food prices just collapse? You know, you never know. You never know in life. Yeah. Yeah, I think that's going to depend. And I think also, too, we may even get good economic data before it gets worse. We may even see growth in between periods of contraction. Okay. And that's what happened in the 70s, too. We had periods of growth in between multiple contractions. And you just have to be really open-minded about everything. I keep saying this over and over and over again. There are no such thing as absolutes when you look forward into the markets. Okay, there's no such thing as absolute. The markets and the future of the markets is a spectrum of possibilities. It's a range of probabilities. Okay. Always think in terms of that. The more, and I know that sounds counterintuitive because I know in a lot of cultures, like being sure of yourself and being confident in yourself is seen as a good trait. I will say this, as a trader, that is probably one of the worst traits, okay, that you can have, is being confident in yourself. It's usually people that have really like neurotic personalities. They tend to be good traders because they always are unsure of everything. And those are the people that actually make it in this business. Those are the people who can actually stay in this business, this marathon, as we say. This business is a marathon. It's not a sprint. And so the people who survive are usually the ones who always question everything. And you have to be like that. There's no story here that you can really cling on to. I think you have to cling on to the data, and the data shifts very quickly. And if the data shifts, you have to follow what the data says. I mean, we saw that on the 15th, or the week of the 15th, actually before the 15th, 15th was a Monday, 15, 14, 13, 12, 11, 10, 9. So on June 9th or June 10th, when we had that ECB meeting and all of a sudden everybody went short and everybody started hedging like crazy in the bond and equity markets. I mean, the data didn't even show that until the next day. Like that was quick. It caught a lot of professionals off guard. You got to be ready for those. Okay, you got to be ready for those. That's why you have to manage risk, and that's why you really have to think a little bit longer term and really think about that worst case scenario before you place on that trade. What is the worst loss I can take on this trade? Always think backwards like that. And if that worst case loss scenario is something that your portfolio cannot handle, then you walk away from the trade and you don't do it. Exactly. You only take a trade that you have an edge on and that you're ready to take the risk, the full risk on. Other than that, you just don't take it. Okay. Hey, man, thanks for joining, dude. I know you could be anywhere else in the world, but you decided to be with us. Very good, very good. LT, dude, it was a pleasure to hear from you again. And yeah, we'll do this again tomorrow. Again, the Twitch feed is gonna stay on. So if you just want to look at the charts that I am looking at for the day and what I'm gonna talk about tomorrow, you can get a hint of that from the Twitch stream. I'll put the recording of this on YouTube. It should be there in the next 5 minutes, and then I will try to be back on for another live call about 45 minutes before the market closes. Maybe I'll get back on. I'll make a quick announcement, and then we'll take a look at some closing trades, or maybe adding on to some of the trades that we have. Sure thing. Yeah, keep popping in. Yes. All right. All right, have a good one, guys. All right. So, yeah, so everybody else out there, I see we got a few viewers on Twitch. Again, I'm going to keep this on. I'm going to put our YouTube recording. You can go into our About section and go to our YouTube link. Join our Discord. We have lots of conversations around this. We have many different traders. We have some people who are professionals in the industry themselves giving out insights. I think it's worth a join. Everything is free. We like to just share alpha with the community. And I invite you to join the conversation. All the links are in our About section. Hope to see you guys soon. And I'll see you later today and for tomorrow's high noon highlights at noon Eastern time as well. Ciao.